Welcome to this explainer. You know that sudden, sickening knot in your stomach right before you panic sell a position, only to watch it absolutely rocket to the moon without you? Yeah, we've all been there. It's basically a universal rite of passage in the markets. But today, we're diving into a completely different approach. We're looking at how to completely strip that crushing emotion out of your trading by using strict, mechanical rules based on smart money concepts. If you were just exhausted from second-guessing your entries or letting your nerves dictate your portfolio, well, this blueprint to eliminating human error is exactly what you need.
So think about that premise for a second. Picture the average retail trader. They're sitting there, palms sweating, agonizing over every single tiny tick of the candle. They're essentially gambling, right? Just running on hope and fear. Now contrast that with the big banks on Wall Street. Do you really think they're sitting there sweating? No way. They rely on cold, calculated algorithms. By adopting this highly clinical, institutional behavior, you can stop guessing with your feelings and start executing like a machine.
All right, so here is our roadmap for the explainer today. We're going to cover eliminating human trading errors, decoding smart money vocabulary, identifying high-value zones, the strict mechanical setup, and finally, executing the perfect trade. Let's get right into it.
Section 1. Eliminating human trading errors. Let's take a look at exactly why our own brains are basically our biggest enemy in the markets.
The core problem here is actually rooted in our biology. As humans, our survival instincts are hardwired around fear and greed. Out in the wild, those instincts kept us alive. But in the financial markets, they pretty much guarantee we lose money. Retail traders routinely make massive errors because of this, like panic selling at the absolute terrifying bottom of a crash, or impulsively buying right at the euphoric top of a rally. But on the flip side, smart money institutions are running these automated, emotionless strategies. When retail traders are liquidating their accounts in pure terror, institutional algorithms are clinically stepping in and buying up those false breakouts. They literally capitalize on our human panic.
So how do we fight back? The secret to trading like the big banks is forcing yourself into a totally rigid framework. The elixir to emotional trading is doing absolutely nothing unless every single mechanical condition in your strategy is met. You have to treat your entry criteria like a strict pilot's checklist. If a pilot is missing a step, that plane doesn't take off. If a step is missing on your chart, the machine stops. You step away. No trade. That emotionless discipline is absolutely crucial. It's your ultimate armor against market manipulation. Moving on to Section 2, decoding smart money vocabulary. Before we can build this mechanical checklist, we have to cut through the jargon. First up is BOS, or break of structure. You can sort of think of this like a freight train just bursting right through a heavy barrier. It simply tells us that a trend is continuing its momentum. When the price breaks through a previous high in an uptrend, or a previous low in a downtrend, it mathematically confirms that the big money is still aggressively pushing the market in that direction. You always want to trade with the momentum, and a break of structure is your definitive proof that the train hasn't stopped yet.
Next is chalk, pronounced chalk, which stands for change of character. This one is vital for knowing when a move is actually over. It's the exact mechanical moment the market signals a valid trend reversal by breaking a previous structural point, like dropping below a previous higher low. When that momentum is lost, the literal character of the market shifts. It transforms from this optimistic buyer's market into a defensive seller's market. Spotting a valid change of character is what keeps you from blindly riding a dying trend right off a cliff.
And finally, we have the FVG, or fair value gap. This concept is super fascinating. Imagine a highly sought-after product instantly dropping to $1. Buyers would rush in so violently it would create a total vacuum. Well, in trading, an FVG is a massive price spike that moves so incredibly fast that buyers or sellers simply cannot enter. It leaves this visible empty gap between the previous and next candle wicks. It's a structural imbalance, and since the market basically hates a vacuum, this gap acts as a giant magnet. Price will almost always return to retest and fill that empty space.
Section 3. Identifying high-value zones. Now we need to figure out exactly where this strategy actually belongs on a chart.
The entire foundation of this mechanical system relies on extreme patience, which brings us to a totally non-negotiable rule: trading on higher time frames. You must identify strong supply or demand areas, often called order blocks, exclusively on a 1-hour time frame or above. Why? Because the lower time frames, like your 1-minute or 5-minute charts, they are just filled with chaotic noise and fake signals. The higher the time frame, the stronger the zone, and the more reliable your mechanical rules are going to be. So at these high time frame zones, you just sit on your hands and wait for a liquidity grab. This is the ultimate trap set by institutions. A liquidity grab is basically a false breakout designed deliberately by big banks to go hunting for retail stop losses. They intentionally push the price just far enough to trigger the panic buttons of everyday traders. By hitting all those stops, they generate a massive pool of liquidity, which is essentially rocket fuel for their own huge trades. Our mechanical goal is to wait for them to trigger that trap, and instead of falling for it ourselves, we just follow right behind their momentum.
Section 4. The strict mechanical setup. This is where we take all these concepts and combine them into a flawless algorithmic checklist.
Think of this as your strict launch sequence. Step 1. Patiently wait for that liquidity grab at your key high time frame zone. The trap is sprung. Step 2. Confirm a change of character. Wait for the market's personality to definitively reverse. Step 3. Spot the fair value gap that gets forcefully left behind. And Step 4. Execute your trade when the price gets magnetically pulled back to retest that fair value gap. It requires intense discipline to wait for all 4 steps. If even a single step is missing, you abort the launch. Period.
Just look at the absolute psychological relief these rules provide. No change of character after a liquidity grab, you simply don't trade. There's zero guessing. When all the conditions are met, you set your entry exactly when the price hits the middle of the fair value gap. Your stop loss goes mechanically just outside that gap, and your profit target is firmly set at the next key level. The chart dictates every single move. You literally just set your orders and walk away. It completely removes human hesitation.
Section 5. Executing the perfect trade. Let's look at the actual mathematical payoff of this kind of true discipline.
By waiting patiently for these highly mechanical, sniper-like entries, your risk-to-reward ratio changes the entire game. The source material highlights how, with this exact setup, you can risk just 1 unit of capital to consistently make 3. This is a massive aha moment. When your mechanics dictate a 1-to-3 ratio, it means you can actually be wrong on more than half of your trades, and you are still going to be highly profitable at the end of the month. Your winners effortlessly outpace the small losses.
And the ultimate takeaway here is endless repetition. You don't master this strategy by magically predicting the future. You master it by relentlessly repeating this exact sequence, waiting for the setup, checking the rules over and over again. In fact, trading should eventually become incredibly boring. If you're bored, it means you've fully automated your process. You're just repeating a mechanical checklist until it's pure muscle memory, totally devoid of adrenaline.
The creator sums it up beautifully right here. It's complicated, but it's not that complicated. You're just one trade away. Yeah, sure, terms like liquidity grabs and fair value gaps sound super intimidating at first, but when you strip away the mystique and break it down into this 4-step algorithmic checklist, it is entirely within your grasp. It turns a volatile, emotional roller coaster into a precise, predictable business.
Which leaves us with this final thought to consider before you sit down for your next chart session. Will your next trade be driven by human panic, or will you let the mechanics do the heavy lifting? The blueprint to eliminate your emotional errors is right here. The only question is, do you have the discipline to follow it, or are you going to let your instincts cost you another trade?